A lot of business owners treat compliance like something that only applies to large corporations. The rules for maintaining a valid separate entity apply regardless of size. A single member LLC working out of a spare bedroom has the same obligations as a company with 50 employees when it comes to the fundamentals. Separation of finances. Let's start with the document that most single member LLC owners skip: the operating agreement. The operating agreement is the internal governing document of your LLC. It defines how the business is managed, how profits are distributed, how capital contributions work. If you're the only member, you're probably thinking, you don't need one. It's for anyone who ever challenges whether your LLC is a legitimate separate entity. If your business is sued and you can't produce an operating agreement, the opposing attorney is going to argue that the LLC isn't a real entity. It's just you operating under a different name. The legal term is alter ego. If a court agrees, the corporate veil gets pierced and your personal assets are exposed. Get one. Forming an LLC is the easy part. You file the paperwork, pay the fee, get the certificate. Most people stop there. They assume the legal protection is automatic from that point forward. It's not. The protection an LLC provides depends entirely on how you operate after formation. If you don't maintain the separation between the business and your personal finances, if you skip the governing documents, if you let your state filings lapse, the legal barrier you paid for starts to erode. And by the time you actually need it, it may not be there. Today, we're covering the compliance requirements that keep an LLC valid and enforceable. The things that most owners forget about, ignore, or never knew were required in the first place. Welcome back. I'm Lauren Switchell, enrolled agent, founder of Zero Fluff Books, and former IRS revenue agent. A lot of business owners treat compliance like something that only applies to large corporations. The rules for maintaining a valid separate entity apply regardless of size. A single member LLC working out of a spare bedroom has the same obligations as a company with 50 employees when it comes to the fundamentals. Separation of finances, governing documents, state filings. Let's start with the document that most single member LLC owners skip: the operating agreement. The operating agreement is the internal governing document of your LLC. It defines how the business is managed, how profits are distributed, how capital contributions work, and what happens if the business is dissolved. If you're the only member, you're probably thinking, you don't need one. Because the operating agreement isn't for you. It's for anyone who ever challenges whether your LLC is a legitimate separate entity. If your business is sued and you can't produce an operating agreement, the opposing attorney is going to argue that the LLC isn't a real entity. It's just you operating under a different name. The legal term is alter ego. If a court agrees, the corporate veil gets pierced and your personal assets are exposed. Get one. If you downloaded a generic template 3 years ago and never looked at it again, review it. Make sure it reflects how you actually operate the business. Next, state filings. Most states require LLCs to file an annual report and pay a fee to maintain active status. The specifics vary by state, so check with your state directly. The trap is simple. It's easy to miss. The notice comes as a postcard or an email. If you don't file, most states will administratively dissolve your LLC. That means the entity is no longer recognized by the state. You're back to operating as a sole proprietor. No legal separation, no liability protection, and you may not even realize it happened until something goes wrong. Put the filing deadline on your calendar. Treat it the same way you treat a tax deadline. Now the financial side. The single most important compliance requirement for an LLC is maintaining a separate bank account. Business income goes into the business account. Business expenses come out of the business account. Personal income and personal expenses stay in your personal accounts. The two don't touch. Commingling, mixing personal and business funds, is the fastest way to undermine your LLC's protection. When you pay for personal expenses out of the business account, you're blurring the line between the business and you. If that line is ever tested, commingling is the first thing the other side will point to. The argument is simple. If you didn't treat the business as separate from yourself, why should the court? As a single member LLC that's taxed as a disregarded entity, you don't pay yourself a salary. You take an owner's draw, a transfer from the business bank account to your personal bank account. In your bookkeeping system, you categorize it as an owner's draw or equity distribution. The key point: don't pay personal expenses directly from the business account. Transfer money to your personal account first, then pay from there. The extra step takes about 30 seconds and preserves the separation. When I was examining businesses at the IRS, I wasn't just looking at receipts and bank statements. I was evaluating whether the entity was operated as a real separate business. If a taxpayer could produce their articles of organization, their EIN confirmation letter, a signed operating agreement, and proof of current state filings, I knew I was dealing with someone who took their entity seriously. Create a permanent file, digital or physical. Keep your articles of organization, your EIN confirmation letter, your signed operating agreement, and copies of your annual state filings. The test is simple. If someone walked into your office today and said, "Prove to me this business is separate from you," could you do it in 5 minutes? Compliance isn't a one-time event. It's choosing the right card at the register. It's filing the annual report the week you get the notice. It's keeping your books current so the financial separation is clear at any point in the year. It's documenting owner's draws when they happen instead of reconstructing them later. None of this is complicated, but all of it has to be consistent. Here's the bottom line. Your LLC's protection is only as strong as your compliance. If you don't maintain the separation, financially, operationally, and in your documentation, the legal structure exists on paper, but not in practice. If you don't have an operating agreement, get one this week. Check your state filing status. Make sure your LLC is in good standing. And look at your bank statements. If business and personal transactions are mixed, start cleaning that up now. Next week is different. Before we move into S Corps and more complex structures, we're going to take a detour into social media tax advice, the viral claims, the myths, and the reality of what holds up when those hacks meet the actual tax code. If you've ever wondered whether that TikTok advice is legitimate, next week's episode is for you. I'm Lauren Twitchell. Keep the fluff out of your books, and I'll see you next week.